Welcome back, Liam, to MyStockScanner Live.
Feels like we're back together again, doesn't it?
Yes, just the two of us without that annoying Jesper asking us questions all the time. No, Jesper had to take off quickly, so it's Liam and I. Today, we are, as always, powered by 3-Point Playbook. Cut through the noise, look at quality, potential, and some timing when we pick our stocks. I was just looking at our portfolio, Liam, and that is just around break even, maybe a tiny red number for the year so far.
Yeah.
What do you think? Are we satisfied?
Actually, with the dip that we could have had, I think we should be quite satisfied. And we're up 5.5%. We dropped to 0, so we lost that 5.5%. We'll just make it back again when the market decides that actually we're not all going to go into a third world war.
Something like that, and taking into consideration that we just cut off the lifeline to the entire Western economy, I'm actually not that dissatisfied. Also today, Liam, something I thought of you this morning when I saw ADOBE was coming with earnings. I know you have been looking forward to that.
Sorry, your sound must have dropped out there. You're just waffling about something. Yeah, ADOBE is a fantastic company. It's everything's green. It's one of the best tech companies that we can see on the playbook. And if I buy it, it's going to drop like a stone.
Exactly. All right, let's have a quick look at the markets today, Liam. Oil pushed past the $100, and that was in the Brent, not in the WTI. And that was, of course, after attacks on some tankers in Iraq and Oman. And while global authorities respond with massive reserve releases, and that have brought the prices down again somewhat. But for how long? That is a good question. Ripple effects are spreading across natural gas, fertilizer, and even coal, which we will be looking at today. Also today, we're looking at BAVARIAN Nordic. Some Danish numbers have come out for 2026. And across Europe, we look at where the defense stocks move again. And in Thursday Tech, Liam will have a big look at the question, could NVIDIA challenge Gemini and ChatGPT? Plus, there are some Salesforce that taps into the debt market for some interesting buybacks. There's, as we mentioned, the ADOBE report earnings today. And then I will have a bit of a go at inflation, which there's a bit of messy stuff in. We'll have a look at the math there today. Also, the number of the day is $4.3 trillion. But, Liam, we're going to have a look at some oil. And that is, of course, because the morning started out with oil bouncing up and then down, and now it's going up again. What do we think about it?
I think no one's got a clue what to think about it. If we just go to oil very quickly, you can see sort of the massive volatility spikes we've had recently. Our view is it's probably going to get worse. There are various commentators out there saying, yeah, it could be fairly muted. But if you look at a country like, I was looking at Taiwan just on the figures because, TSM is there and they're a major producer of tech. 35% of their electricity production is coal-based. And you see that a lot around the world. In the poorer countries haven't been able to afford to wean themselves off of coal, and even the less poor countries in Europe over here. So, and oil and things like that. So I'm moving on into the coal argument as well at the moment, but everyone is starting to suffer and look to the next 6 to 12 weeks to say, okay, how much are we going to suffer from not having access to oil, not having access to fertilizer, aluminium, and helium and things like that?
We are having access to oil because International Energy Agency came out yesterday saying, all right, we'll put out 400 million barrels of oil. We don't know how much per day, but probably somewhere in the 3 to 5 million barrel
Look
range.
at how the market took that. It went up by 6% today. So they were really hoping to push it down. So what's the problem with that is the IEA hasn't actually said how many barrels a day it's going to release over what type of period. So there's a huge amount of sort of lack of knowledge in the market at the moment.
And should we recall back in 2022 with the attack on Ukraine, we put something like 180 40 million barrels out, but that was only 1 to 1.5 million barrels per day that was necessary. Right now, we are talking 4 to 5 million just to cover the first little hole in supply. We are actually lagging between 10 and 15 million barrels per day.
And the issue, I mean, the Saudis are looking at, there's a couple of pipelines that actually bypass the Straits of Hormuz, but they're going to be such easy targets for the Shahed drones and from Iran. So
Indeed.
I think there's going to be a lot of issues coming forward.
But as you said, it's not only oil. We have been looking at natural gas. A lot of the LNG, the liquefied natural gas, comes out of Hormuz, the Strait of Hormuz. And we were talking about fertilizer the other day. Those stocks are going up quite nicely. Could you find something like Nutrien or Mosaic in there in your chart? I think we can have a good look at them.
Mosaic, one of the larger ones, Mosaic. We've been looking at this for a while, haven't we? It shot up yesterday because everyone's starting to realise that we could have a problem coming through.
And actually, Mosaic is the only one. We mentioned Yara, Mosaic, CF Industries, and and they were all of the others are actually in an uptrend. Mosaic is the only one that is coming from a bottom here, which could make it an interesting play.
I don't particularly like this gap. We talked about this before. They've had a couple of really big gaps down over the past 6-7 months, so that's not something that instills me with a lot of confidence.
Looking at them in the 3-point playbook, all of them have earnings pointing downwards. One of the reasons is that the market had been crashing a bit for fertilizer the last year or so, but that might come to an end now. We also looked at helium the other day, which is a thing I actually, to my surprise, I didn't realize that it was such a big thing coming out of the Hormuz as well.
Byproduct. But so the helium is a big issue. The other thing that's going to be an issue is copper prices potentially, because copper smelting very much relies on liquid natural gas, and we've just lost 20-25% of that. So there's going to be issues across the board.
We have had a lot of questions as to why copper went down, and we actually had the Freeport-McMoRan stock that went down as well, and that is simply because of the energy cost. It's really, really energy intensive to get the cover ready, and that costed a lot there.
I think also people are slightly worried about recession going forward, and that's going to massively drop the use of copper because it's not used as much in buildings, electrical wiring, and those sort of things.
But you were mentioning coal.
Yes,
coal. Yes, and what is it with coal?
Well, it's sort of not in a war zone at the moment, the production of it, or a lot of it. So we can get to it. A mine that's been sort of shut off can be fairly easily opened compared to an oil well or something like that. So, I mean, you were looking at this yesterday, weren't you? And came up with an ETF that actually looks quite interesting. If we look on the screen here, that actually is, like people who follow our 3-point playbook, we will get more into stocks in a second, but you can see it's in a constant uptrend. It's absolutely motoring and has been for quite a while now. So we probably would have come in sort of somewhere when it's above its 50 around here or something. So it's something that we've identified that could actually plug some of the gap in electricity production. As I say, Taiwan, as an example, 30-35% of its electricity production is coal-based, and that can increase and take over the oil side of things that's going on.
China as well, and China is also they are halting the export of oil, at least in March for now, and let's see where that goes. I know US were talking about the same. Maybe they should stop exporting oil, but then a lot of the receivers of that oil said, okay, well, we have contracts with you, so if you do that, we just stop exporting other stuff to you.
I would probably say the US could, the thing they could do is stop bombing oil producers, and in that area, then that will probably solve.
What a radical idea. All right, if I just quickly show, and that is the reason why on the coal side, we are a bit in the same trouble as we were with the fertilizer stocks, because and that is the reason why we haven't entered any of the fertilizer stocks, because the 3-point playbook is simply not very good. We can see here Yancoal from Australia dropping earnings per share, revenue is dropping, return on capital. It's not a quality stock, And now we don't have any estimates in here. That is why it's just showing like this. However, if someone runs out and buy a coal stock, we could buy a coal ETF maybe. But if you buy a single coal stock, it could be that tomorrow Trump does a taco and all of a sudden there's no war in the Middle East and the Hormuz is open. And if you have not bought a quality stock with good potential at the right time, then you are in for some heavy beatings in the market. Whereas if you buy the good quality with good upside potential, the downside is often not that severe. However, let's turn our eyes to Denmark, where we have had earnings from BAVARIAN. And if we look at it, it's for those out there not knowing BAVARIAN, it's a vaccine company. And it was funny when the pox, what were they called? It was not allowed to call monkeypox, I think. So let's call them something else. But when that was running, you could follow the stock price and the number of poxes, cases of poxes every day. They were correlating quite well. However, if I just share my screen quickly, BAVARIAN came out with some stellar numbers. It was really, really good. They have a good quality, earnings per share. It is a biotech medical research thing, and we know how we feel about them. We're a bit uncomfortable with the smallest of them. Revenue fairly stable, good PEG ratio, and actually the free cash flow is just turning positive here. It actually looks, when we are comparing to other companies in this industry, it actually looks fairly good. Then we have the value chart here, and that is just terrible. Analysts don't think it will go down 100%. It's simply because there's not any estimates here. This is not something we want to buy into. You should think with the numbers that came out today, if I just find it here, BAVARIAN in the Danish version. They came out and beat on revenue and some on margins that were really good, but the stock is going down. I'm not sure why. It might be because their CEO is stepping down and someone new is taking over. I'm not completely certain about that, to be honest. But that is an interesting thing, and I know a lot of people in Denmark are following that. However, out in Europe, Liam, there is something going on in defense again, or is there? What's your take on it?
My take is they're expensive. There is something going on, definitely. I mean, if we, all this news has really brought defence stocks back into the frame again and back into the conversation. Saab is an interesting one. It went down yesterday, but it's back up again today. If we look at their chart, they're still in a good uptrend going up there. You can see sort of this green line and the black line. The green line is the 50-day moving average, and the black line is the 200-day moving average. And that's what we tend to use to show whether a stock is in an uptrend, as well as our MTR own sort of bespoke MTI indicators here, which also confirm whether a stock is in an uptrend on a daily basis and a weekly basis. So we can see it's double green here, and everything looks pretty good. The problem we've got as we go back, I mean, let's just start the question one. Is Saab a decent company? Absolutely. Everything is green across the board. It's quality score of 88 out of 100. So it's one of the top 100 stocks in Sweden. You've got earnings going up. You've got the PEG ratio, slightly high over the 2.5 that we like. But everything else looks really, really good, to be honest. The problem comes in, the question one is answered, question three, both of them get a tick in the box. We're right up the top here. So there is some upside. We'd really like to see it go down a little bit. And you can see I've just set my chart here so that the peaks recently and the troughs have really matched the green lines and the red lines, and then set the blue line in the middle. And we can see, there is a 10% upside by the end of next year and 32% upside in where we think it's probably going to be. So the 10% is the worst case scenario if we held for a year and a half. However, if we just wanted to hold for 8-9 months, you'd be looking at a risk of 13% on the bear case, and you'd be looking at a base, where a 5% profit. So the risk reward probably isn't quite right because it's just in the expensive zone, and we see that with all of them.
And except one, I actually have had my eye on one of them, and that is the Italian Leonardo. Actually, also the US Leonardo. As
Yep.
far as I can tell, they're two different
I
companies.
think they're different, aren't they?
Yeah, but Leonardo here, LDO, is, and it's a good example of that, whereas this last year we could just pick any EU defense stocks and then it was good. Everything went up. Now it's a lot more of a stock pickers market. And just very quickly, good quality earnings per share, revenue going up, stable return on capital employed, free cash flow, good interest coverage, and actually, depending on where you put your channel, but this is at a 25 to 38, and I think your SARP was up in the 50s, if I don't...
Yes, it was.
Yeah,
50 for the base
so
case.
this is actually potentially a fairly good case, at least if I am looking at this and just looking in the charts here. It has actually made my favorite formation here, where we had a lid on it, where sellers are coming in around 60 and buyers are getting more and more desperate to get in, and then all of a sudden it pops, and there could be some potential in that.
This is good. We get rid of that buffoon Jesper, and we can talk about our favourite chart patterns and things like that.
Exactly.
We're not allowed to otherwise, are we?
Oh well, I did talk about it in the
Okay.
in the Danish part of the show, but Liam, we shouldn't waste our time. That is what Jesper would say, and we should look at Thursday Tech, where we did mention the ADOBE numbers, but I would rather hear your take on that video. Potential challenge. What are we talking about?
Yeah, I haven't written the Thursday Tech yet, but I've got my notes. And one of the things I spotted, they came out with a new AI model. So not many people maybe know, but they actually do produce some models themselves. And so a bit like ChatGPT and things like that. These are what's called open source models. So it means all the weightings for how the model makes its decisions are actually open out to everyone to look at and to play with and to change. So that's very different from ChatGPT and Gemini, where they hide those things because it's part of their sort of mystique and their unique selling sort of ability or unique proposition. So NVIDIA have come out with this open source model. It's pretty good, but that got me thinking. They're a tech company. They're the largest company in the world at the moment. They have a stranglehold on the GPUs and the AI chips that are actually producing the AI content that we see everywhere these days. But in 3 or 4 years' time, other competitors will have caught up. So their chip business will suffer from sort of falling margins because they've got competition. So I wonder whether they're thinking, putting themselves in a position where actually they become a producer of an AI model like a ChatGPT or a Gemini or an Anthropic, and really come out as a competitor. So it's just really thinking of that. But it also gives us a really good excuse to look at the thing of beauty that is NVIDIA in our playbook. Everything pretty much is green. The health score, the Petrosky health score is quite an old metric, so it's not one that we really use too much. But you can look, for the biggest company in the world to grow their earnings by 30-40% in a year is just absolutely huge, and another 25% the next year. That's what analysts got pegged in. Revenues are going up. Analysts love them. They've gone up 10% and 7% in the last 90 and 30 days. So they've increased what they think NVIDIA are going to produce. Their free cash flow is literally off the chart. So they've got loads of money to invest. Price free cash flow, a little bit expensive maybe, but then when we go on to the valuations, we look at, okay, where could they go? So I've really set my base case to match the April low last year. And there are a few points along in the last couple of years where actually the green line, the bull line, where the perfect scenario is actually, the stocks hit that and retreated. So I kept it there. And then the blue line is pretty much where we are now. You could actually just reduce it down a little bit. But that shows that actually in the next 10 months, 11 months, analysts think we could go up 10%. In the worst case, we actually think we could go up 34%. And in the best case, we think the stock could over double. So from an NVIDIA...
Should we mention we have it in our portfolio, just for a quick disclaimer?
I think we probably should. So we are invested in this, but this is the reason why we're invested in this, because it's actually, by the numbers here and by the multiples that investors in the past have actually invested in the stock. 3-year average of the PE ratio is 44. So investors have been willing to pay 44 times their earnings to actually get into the stock, and we're saying that we can make money at 36. So Fantastic
Perfect.
stock, and it's just about hanging on to its position. Dropped down a bit, bounced off the 200 days, so that's good. So Nvidia, I'm just throwing it out there that they could be looking at sort of adding another string to their bow.
Yes, Liam. Before we leave tech, could I ask you to find Salesforce on a chart?
Yes.
Because there's something not funny or not weird, but interesting. Let's call it that. Something interesting has happened. They have borrowed a ton of money for what?
Yeah. They announced in their earnings recently that they're going to be buying back $60 billion worth of shares. So they've got the cash that says we're going to buy back the shares. But they also announced last night they're going to borrow another $25 billion off debt markets so they can buy more shares back. And effectively, a company will do that when they see there's such value in the shares, but the share price has dropped so low that the best thing they can do for their shareholders to inflate the price is to buy back a shed load of shares. And that's the way you manage, and count these things. It's shed loads of shares is the technical term for it. So this is where we say, okay, software has been beaten up so badly, and I've gone through that a number of times in the tech pieces that I've done over the last few weeks. This could be the bottom with the stocks and the companies actually saying the best thing we can do with our money that we've got right now is not develop a new product or develop more AI. It's actually to buy the shares back because we believe there's far more value in it than in doing anything else. So that's a really bullish sign for me.
We saw it with one of the other tech stocks where the CEO bought $150 million worth of, I can't even recall which one that was.
I can't actually recall which one it was. So
it doesn't matter.
Matter. And the other one I just very quickly mention, Macom from last week. Bounced off of support. Really good company, and is looking to go back up again, potentially there. So that's something definitely on our radar.
Great. If I may just add a quick thing on the program, and that has nothing to do with tech, and then again, maybe a bit, but yesterday we had inflation numbers. And some people have asked why I didn't comment too much on that. They were quite where we expected, or everyone expected them to be. However, I'm going out on a little limb here. I'm putting my my guess out here and saying that in 3-4 months it will be 3%. Why is that? It's pure math. I won't tire you with that today, but looking at what numbers it's a 12-month period, and that means every month we move a data set. And the data that is disappearing out from 2025 now, the next month, are very, very low. And with the energy and everything that's coming into the inflation calculation, we'll probably get some elevated numbers for the next month here. So I would be surprised if this number is not reaching close to 3%. Then, of course, there's a little detail about October, November's data mysteriously missing. It's not
zero, isn't it?
Counted. There's a big round zero because of the shutdown. So when we get to October, November, there will be some extra added there. So who knows? Maybe 3.5-4% at the end of the year. But the 3% mark here before summertime, I am fairly certain. Another thing I want to mention, and that is a thing. We are getting a lot of questions. For instance, the thing about inflation. And next week on Tuesday, English with Liam and Jesper, and then on Thursday the 19th with Jesper and me at 7 o'clock Danish time, we are having a Q&A session again. We're doing them once per month, and feel free to sign up to that. We are answering anything, but send us an email on fomo@mystockscanner.com if you have any questions, basically for anything around MyStockScanner, our 3-point playbook, and we will go into some specific themes about how we get out of stocks before they crash. All right, isn't that about it, Liam? Number of the day.
Back, then?
The what?
Is he coming back?
Jesper?
That middle bloke.
I don't know. Off the door. I can hear someone knocking out there. It might be him. Now, let's get to the number of the day, because that is a quite large number, $4.3 trillion. And what might that be, you think? Well, that is the GDP of California. Let's just have a quick look at some graphs here. If we look at 1990, we can see the Republic of California, whatever they call their flag down here, was 0.77 trillion, so $707 billion, way below Germany and Japan. And also notice how far down Germany was compared to Japan. And now we are actually seeing California as a state being higher than Japan as a country, and just a bit shy of Germany. That is insane. It's not very investable, but I think the numbers are just staggering. That and it shows how much power California actually has in
the US generally,
in US, and maybe why Trump hate that Gary Newsom guy so much. Who knows? All right. Just before we go, there is still some news this week. There are some PCE numbers coming out, also inflation numbers, and I actually think they're a bit more important PCE numbers coming out tomorrow. And we also, we have the ADOBE earnings. Today we get a trade balance from US, and had there not been a war in Iran, I would suspect that would have been filling up a lot, because that is a number Trump wants to be in positive, which has been going more and more negative lately, seeming that the tariff war is not really working the way he thought it would.
Does that not work, that sort of thing nowadays then? I thought it did.
I'm
sure I've seen some tweets or something like that. Yeah.
Yeah, sure. Anyway, I will be back here tomorrow. And Jesper is also off there, so I'll be all by myself. I can spend all the time I want, just really going into some nerdy details. So, but till then, Liam is putting up his Thursday Tech article, and that is an interesting read that I think you should all read. Tomorrow I will have a face-off, which is between two giants, that is GM, General Motors, and Stellantis. So thank you for listening to us today, just the two of us, Liam and I. We don't guess, we don't stress, not that often anyway. We just use our 3-point playbook where we look for quality, upside, and timing. Happy investing out there, and stay safe.